Investigations Subcommittee, Mr. McHenry, for 5 minutes.
Well, I want to thank my colleague on the other side of the aisle for bringing up those issues. It sounds like it's not really about Volcker that he's talking about, because Bayer and Lehman didn't have a single deposit. They're not depository institutions. So the concerns that he raises are genuine ones, and concerns that we've raised in a series of hearings on Too Big to Fail in the Oversight Subcommittee that the chairman has directed. And the concerns we raise as a question of this is the scheme that Dodd-Frank puts in place that does not end too big to fail. Mr. Johnson, would you agree with that? That concern that we have that Dodd-Frank does not end too big to fail?
Too big to fail is still with us, Congressman. But unfortunately, all of the what we previously known as investment banks have now converted to become bank holding companies.
Exactly. We've talked about
that's an important part of the issue. You can't, and that's why I agree with Mr. Lynch that these things are bundled together on a forward-looking basis. Whatever you think happened in the crisis,
right,
it's all bank holding companies now.
But Volcker actually doesn't end up protecting the taxpayer, which is a genuine concern I have, that institutions, private sector institutions, when they fail, that the taxpayers become on the hook for this. And look, we've had good conversations about this as well. But the question I have for the panel today, can you put a dollar amount on the cost, the economic consequence of Volcker as is now set in stone by the regulators? Mr. Benson, do you have a dollar amount?
No, sir, we can't, because we're
okay.
having to go
Mr. Funk, do you have a dollar amount?
No, sir.
All right. Mr. Johnson? Or Professor
yes.
Johnson, I'm sorry.
Yes, Congressman. I think it's part of what's being displayed on the wall here. According to the Congressional Budget Office, the effect of the financial crisis is to increase our debt over the cycle by about 50%.
No, I'm asking.
50% of GDP, half of GDP, call that $8 trillion because of the financial crisis and depth of the recession that created.
So Volcker
Rule addresses precisely the way in which these largest bank holding companies, as they are now, can take risk, can disrupt the economy, their ability to do this.
I understand. I've got limited time, and the chairman's using the gavel today. Actually, very well. I'm glad I got to ask a question before noon. So, but to your point, Professor Johnson, for me as a policymaker, I can't simply say, well, Volcker just saved us $8 trillion. Mr. Gantz, do you have a dollar amount? Okay.
The dollar amount I have is $7 billion if the market moves 10%. It could be greater than that, but that's the amount that it would impact the CLO market unless there is some remedy very, very quickly.
Mr. Johnson. Oh, I'm sorry, Mr. Robertson. Sorry.
There's absolutely no way to put a dollar figure.
Okay. So part of the concern is this. We have, as a matter of the Securities and Exchange Commission, written policy that they will have a cost-benefit analysis before they codify rules. We've had a lot of good ideas across the whole panel here today on ways to improve the Volcker Rule as it's written. If it's going to be there are some genuine concerns that we can mitigate the downside of this. And yet at the same time, if we had an interim final rule, we could resolve these things without in real-time market consequences in the way that in the rush of these 5 regulators to get things done, they've done. And the rush was to get the rule done, codified, and rolling, and then try to tweak it in real time. The TRUPS issue is a great example of this. So I have an additional question. Mr. Benson, who is the primary enforcer of Volcker?
There's not a primary enforcer in our view. There are 5 enforcers, and maybe 6 if you add FINRA to the mix, which I think ultimately the SEC will look to FINRA to do.
Mr. Funk, I mean, as a bank, I mean, look, you've got plenty of regulators, right?
We are a publicly traded bank, so for us it would be 3. It would be the SEC, it would be the FDIC, and it would be the Federal Reserve.
Okay. So, Professor Johnson, this final moment I've got. As we said, too big to fail is still with us. You have been an advocate of simplicity, simple institutions, simple regulations. What is happening in Great Britain and what Andy Haldane has done in terms of this discussion on simplicity. This is a complex rule. And would you think that there's a better approach to this? I mean, what you said is this provides a, quote, good chance that it will reduce risk. you're really not willing to go on the line and say this absolutely will reduce, risk. You're saying it has a good chance.
Briefly.
I think it depends on the implementation. I worry a lot about this number up here, and I don't understand, Congressman, why you, with your justified concerns about this number, cannot draw the link, the very obvious link, between the depth of financial crisis in the future and the impact.
Time of the gentleman has expired. The chair now recognizes the gentleman from Georgia, Mr. Scott, for 5 minutes.
Thank you very much, Mr. Chairman. Appreciate it.